Hi, we're back again, or I'm back again. So sitting here in my San Joaquin Delta College sweatshirt, just thinking about class and wanting to talk with you about one of the topics in Module 1 lecture. And that's the one about the typical business cycle. I hope as you read through the module, you're getting an idea of, a little supplemental material to our textbook. And this one talks about the business cycle, just to get you used to thinking about business terms and concepts. Talks about the 4 steps in this cycle. And we think about peak, and that's where we're talking about, everything's going very well. People are employed, businesses are doing well, the economy is going well. And then you always read in the newspaper about the fear of recession. And recession is that slowdown of the economy. Remember how earlier we had talked about gross domestic product, and that talks about the economic growth and such. And so then you start to think about recession, things start to slow down. You see the growth of GDP slowing and starting to go into a trough. And so that's where you start to think about the trough is that depression. And that's when GDP may go to a negative. And then we think about recovery, and that's where we're going back up. And things are growing again, and people are getting employed again. And so you think, how does this cycle work? How can you manage that cycle? And there are basically 2 things that the government can do, and that's monetary policy and fiscal policy. Now, monetary policy is when we basically talk about the interest rate, and that's the Federal Reserve System. Later in the semester, we're going to be talking more finance and talking more about the Federal Reserve System. But I thought you wanted to think very early on about what you read in the newspaper about interest rates and how the Federal Reserve is thinking about, do they raise interest rates? What that means is they're going to raise interest rates on the banks and maybe demand that banks have to hold more money in reserve. And that's where you start to read about that. And that's basically monetary policy. Because you think if the Federal Reserve System eases interest rates, makes it easier for a bank to lend money, interest rates drop as the banks want to get money out into the economy. You and I borrow money, we buy stuff. A business borrows money, they buy stuff. And that fuels the economy. And that's where you start to think about monetary policy. Then the other one that you think about is fiscal policy. And that's really talking about the budget of the government, how the government spends money, how the government raises money. And so the way government raises money is through taxes. So, if tax rates go up, we have less money, we can't spend that money, therefore the economy slows down. And then if we lower tax rates and we're spending money, the economy is growing. So you start to think about these sorts of things as you look through our course and think about how the government impacts our economy 2 ways, monetary policy and fiscal policy. So I hope that's done some clarification for you. And obviously we'll be talking more about various terms and concepts as we go from one module to another, as we cover different topics within our course. So I hope you've enjoyed my little discussion. Remember, if you have any course questions or thoughts, or you want to make some comments, just send me an email through our Canvas inbox system, and I'll really appreciate your feedback and get back to you with an answer about any of the questions that you have. So again, thanks for watching, and we'll be talking soon. Bye-bye.